Hey everyone, and welcome to another episode of Brett's Brain. In the past, we've talked a little bit about employee stock option pools or equity pools and what they are, why they matter. Today, I want to talk about why investors care about them and why, if you've ever raised a round of venture capital, oftentimes in that term sheet or in those deal docs, you're going to have a requirement of setting aside or creating a pool of some certain size. It could be a 10% pool, a 15% pool. Why do investors do that? And how does that work? They really do it for two reasons. The first is that they understand the importance of having equity to help incent people in and or around your company. So we talked a little bit about that in the past. That could be advisors, employees, even the current founders or for new hires. It's a great way to attract and retain talent. But the second reason is they realize that to do those things, you're going to need to issue shares. And when you do create an equity pool, it becomes dilutive. We've talked about dilution and what that means in the past. But if any time you issue a 10% pool, anybody that's on the cap table is going to have their ownership percentage reduced by 10%. And so what an investor wants to do, because they know this is an important thing to have, and because they know you're probably going to have to use it to go attract talent, they want you to set up that pool before they invest, because they don't want to take that 10% dilution. And so that's why they push for it ahead of time prior to closing or as a part of closing a round, that you will have established that equity pool. It is an important thing to have. It's one of those terms that you can negotiate as you're going into a venture capital round. So that's why investors care, and that's why timing matters of an equity pool for employees.